So many people enjoyed the video I last posted where I show you how you can 10x your money in just a week, but it's come to my attention that not everybody knows how to close out of those trades before expiration. So today we're talking about how to exit option strategies early in order to secure profits or mitigate losses. But first, I'm going to start off with a guide to trading options for all my beginners, and then we'll get right into how to close out of options positions, including the 10x strategy I showed y'all in the last video, which I'll link right here for anyone who missed it. If you're new here, guys, welcome. My name is Ace Hunley. I like to share financial strategies to help you improve your situation. So if you like that, be sure to hit the subscribe button so you don't miss out on future content. So how do options actually work? Well, first off, every option strategy boils down to some form of buying or selling calls and puts, or some combination of both. Now, just so we're on the same page, when I say I'm selling an option, I mean I'm writing an option, which means I'm creating a contract. And typically for writing an option, I'm going to receive a credit, which just means I'm going to receive money in the form of premium from a buyer, which is non-adjustable and non-returnable once the agreement has been made. Typically, this is shown inside of a brokerage account as a -1. The opposite of that is buying options. So when I buy a call, this is generally going to cause a debit, because when we buy things, we have to give money away, which in the options world, we call that a premium. And this is generally shown inside of a brokerage account as a +1. So we sell something, it's going to show a -1. We buy something, it's going to show a +1. And you'll notice the significance of this +1 or -1 later on in this video when we go to close out an option, so you're going to want to stick around. Before you enter an options agreement, it's important to know all the possible outcomes. But before we get into that, we need to understand some terminology that we use quite often in the options world, specifically the terms in the money or out of the money. So let's look at a real world example. So we're going to go ahead and come over here to Robinhood. Let's see here. And just for our example, just pulled up a random stock here, Apple, and this is the options chain. For those that don't know how to get here, we can kind of back out a little bit and go back to Apple. And right here, you're going to see the stock, right? And on the right hand side, you're going to see trade Apple options. You're going to go ahead and click right here. And voila, you got the options chain. So what are we looking at here? These are the contracts that are expiring this week. And what's important to look at here, just for the point I'm trying to make, is on the left hand side, you're going to see different strike prices, right? And the significance is, if today were to be, let's say January 31st, and let's say all these were expiring here in just about an hour, you'd want to be an owner of a contract with a strike price down here. And why is that? The reason why is at the end of expiration, and if I don't close out my trade, I will have the option to, let's say, purchase 100 shares of Apple for $225 each, right? So what does that mean? That means I will have a option to profit $6, right? $6.60, right? The difference between 231 and 225. $6.60 times 100. Let's do the math here. Bam. So I will be in the money, right? That's because I will have the right to basically make $660 of profit if I want to, all right? Now, why are all these out of the money? Well, at the expiration, if I don't close out these trades, let's say I own a contract for a $240 strike price. Well, at expiration, I will have the right to purchase 100 shares of Apple for $240, although they're trading right now for $231. Obviously, no one would want to do that. So all these contracts here trading above $231 and 50 cents, they're what we consider out of the money, which just means they're worthless come expiration. Hopefully that gives you guys a very good explanation and understanding of what in the money means versus out of the money, which you're going to need this understanding to really gauge and understand what I'm going to explain next. So when you enter into an options agreement, it really boils down to three different outcomes. Outcome number 1, the option expires out of the money, which just means the option expires worthless, just like I was showing you in the real world example earlier. At expiration, meaning the value of that option is now 0. This means regardless of what the value of that option was over time, at expiration, it's out of the money, so it's worthless, which means the option is what we call out of the money. This is great for sellers and bad for buyers. If I'm selling options, this is when I'm going to make the max profit. I get to keep the premium I was given in the beginning as a credit. I get to keep my collateral, whether that was cash or stock equivalent. And so oftentimes I end up rinsing and repeating that process over and over again to make additional income. Outcome number 2, the option expires in the money. This scenario is typically great for buyers and bad for sellers. In this scenario, one of two things really happens. Number 1, if I was the seller or the writer of that option, I would be what we called assigned, which just means I would be obligated to either purchase 100 shares, typically for more than what they're trading for in the open market if I had written the put, or I would be required to sell 100 of the shares I own, typically for less than what the shares are going for on the open market if I had written a call. On the flip side, if I had bought a call and let it expire in the money, my broker would then exercise my right to buy 100 shares, generally for less than what the shares are trading for on the open market. And if I had bought a put, my broker would then exercise my right to sell 100 shares, generally for more than what the shares are trading for on the open market. Keep in mind, when an option expires in the money, as the seller of an option, I am actually obligated to either sell or buy shares, but as the buyer of an option, I'm not obligated. Instead, I have a choice. I have the option to buy or sell shares at a price that was predetermined at the time of the agreement. That's why we call it options trading, because instead of trading ownership slices of a company, we're literally trading the right to have a choice to either buy or sell shares at predetermined prices. Let's say, for example, I own a call option with a $200 strike. Today is expiration. I don't end up closing out before 4 p.m. Eastern. I just let it expire. The share price ends up trading at $215 at closing. My broker will exercise my right to buy 100 shares of this company for $200 a piece, even though they're worth $215, right? But I have the option to call that broker up to an hour after closing and have them not exercise my right. Technically, I really have an hour and a half past closing, but I wouldn't want to risk it because then it turns into a best effort situation. All this to explain the difference, because if I'm the writer or the seller of that option, I really don't have the ability to make such a phone call. The third scenario is I exit my position before expiration. I'm going to want to do this for one of three reasons. Number 1, I'm locking in profits because the value of the option is in my favor and I want to exit and just close out of that option. Number 2, I want to cut my losses because maybe I'm in a trade and I don't think it can end well and the value is just diving and I just want to get out. I want to stop the bleeding. Number 3, I sometimes will roll my options further out in expirations or up in strike, either because I want to realize the gains or stop the bleeding. I typically do not want to be assigned, nor do I like to typically exercise my right as an option holder, so I generally always close out my options before expiration. But how do we close out options positions? Well, let's first understand what's happening when we start a contract or when we enter an options agreement. So the first options agreement I'll go over is called buying to open. For example, I'm saying, hey, I got $49. Does anyone have a contract that has a certain strike price and a certain expiration and you'll take $49 for it? And then there's someone over here And they're like, yeah, I got a contract that fits that description, but I want $51 for it. You'll want to pay some attention here because you'll see this often when you're trading. So my offer for 49 bucks is what we call the highest bid, right? And their offer to sell their contract for $51 is what we call the lowest ask. That's because theoretically, at this moment in time, he or she is selling the contract that I'm looking for the cheapest price. Distance between the highest bid and the lowest ask is what we call the spread. And typically when I log into my broker, I'll see a number next to where it says bid. This is because out of all the people looking to purchase a particular contract, this person here, right, which is me, is the highest bidder at the time. So I may not even see that there's a bidder right behind me that's at $48, right? Unless he jumps in front of me by changing his bid to 50, at which point my bid would drop back to the second place and wouldn't even get filled prior to his $50 bid getting filled first, which then pushes my $49 offer back to the front again. Now let's say I really want to own that option, and so I raise my offer to $50, which is right in the middle of the spread, what we call the midway. And let's say the seller meets me there and he accepts $50 for this contract. So now I take this contract, right? And me as a buyer, now I get debited 50 bucks for the contract that's now in my hands. On the flip side, I can always sell to open. This is going to be with covered calls and cash secured puts. Now, keep this in mind. When I say sell, we're talking about writing. So here I'm going to write up a contract, right, for someone to hopefully purchase. This contract is going to have the strike that I want. It's going to have the expiration that I want. And most importantly, it's going to charge a premium that I feel justifies me taking the risk of being obligated in the future to sell or buy 100 shares at a price that would ultimately be unfavorable to me. Now say I want that premium to be $51. So I say to everyone, hey, I got this contract with this strike and this expiration, and I'm looking to get 51 bucks for it. And then a buyer over here, he appears and he's like, look, I'll take that contract, but only for 50 bucks. And I say, you know what? I don't think someone else is going to come along with a higher offer anytime soon. So let's make a deal. So he sends over 50 bucks. Oh, really bad handwriting there. And I send him over the contract. And that's how we sell to open. Now, the biggest takeaway from all that was when you buy to open an option, you get a +1 in your brokerage account and you are debited premium. Conversely, when you sell to open, you get a -1 in your brokerage account and you are credited premium. Now let's take a look at some instances where I could possibly want to buy to close. Let's say I owned 100 shares of XYZ company, and in order to produce some extra income, I sold a call against those shares that expire 30 days out, and in doing so, I collected a credit of $50. So right now in my brokerage account, it's going to show a -1 call, meaning I wrote one contract. So my premium value chart is going to start right here at $50. Now, over the next 20 days, let's say the value of the premium for the call I sold moves like that. We want it to hopefully stay down because we want it to expire worthless, which in this case, I would get to keep the entire 50 bucks and my collateral of 100 shares of XYZ company, freeing me up to rinse and repeat the process for even more income. Now, let's say 5 days rolls around and the premium is only worth $45. So at this moment in my brokerage, it'll show an unrealized gain loss of +$5. Because the current value, the $45, is less than what I sold it for by $5. So I could at this point right here buy to close and secure my $5, But I think to myself, let's go for a bit more profit. So I like to do nothing. Let's say day 10 rolls around. The share price moved in the wrong direction, causing the premium of this contract to be worth $75. So for the time being, my current unrealized gain loss, instead of showing positive $5, it's going to show negative $25. Because if I would have waited and sold the call right here, I would have received $75 instead of $50. So let's say I decide to wait it out and see what happens, and day 20 rolls around and the premium is worth only $30. At this point, the unrealized gain loss in my brokerage platform says positive 20. In that moment, I'm in the profit zone for the second time because the current value of the option is less than what I sold it for. This is where I have a decision to make. I can either buy to close right now and lock in those profits, or if my research tells me to do so, I can continue to wait until expiration in order to hopefully collect the entire $50. Let's say looking at the chart, I can see the tail getting ready to curve upward. So at this time, I decided to buy to close. So now what we did was we started with a $50 option is now worth $30. So now there's someone else who wrote a contract with the same expiration and same strike of the contract that I sold to this guy earlier. And they're like, this guy's like, hey, I got this contract I'm selling for $30. Does anybody want it? And me over here, I'm like, shoot, yeah, I'll take it for $30. So what I'm going to do is I'm going to buy to close. I'm going to get debited $30. And now I'm going to receive the contract. So if the buyer of the original contract I sold ever wants to exercise his or her right as an option holder, this new person that sold me a contract just now would have to fulfill that obligation. The buyer of the contract I sold the call to earlier will not know the difference between the call they bought from me versus the call that I just bought from this new person, because the strike is the same, the expiration is the same, and of course the company is the same. In other words, by selling a contract and then buying the exact same contract from someone else, hopefully at a cheaper price, I have essentially removed myself from the equation and either walked away with a gain or loss. Because now these guys are connected because this new seller is the one who has the obligation now instead of myself. In our example, I have walked away with a $20 gain, and this can happen all the way up to expiration. So when you decide to buy to close or how much profit you decide to take, it's 100% up to you. It's all personal preference. So that's what buying to close means. As a rule of thumb, I typically always close out options before expiration, unless I actually want to own shares, in which case I wouldn't mind getting assigned in the instance where I sold a put and the share price is trading in the money at expiration. But now how do I close an option position? Well, if I want to exit my position, all I do is the reverse of whatever I did when I executed the option strategy in the first place. I just have to be sure to use the same expiration date and the strike, so all that matches up. For example, if I have a -1 call that expires February 28th, meaning I'm in a position where I have sold a call, in order to buy to close, what I'm going to do is simply buy one call at the same strike and same expiration of February 28th. And if the premium I pay now is less than the premium I collected, I'm going to walk away with a profit. Another reason I'd want to buy to close would be to cut my losses or just stop the bleeding. In those cases, if the premium I pay now is more than the premium I collected, then I would be considered having a loss at this moment. Now, what does that look like on the buy side? What if I'm buying the option instead of selling it? Well, it's still a $50 premium. What I want when I'm the buyer of that option is I want the value of that option to go up due to how much time is left till expiration, due to how high the share price is trading at, due to how much and how fast the share price is expected to swing by. I want this price to go up. So now over some time, maybe now it's trading at $65. Well, now I tell everyone, hey, I got this contract, it's worth $65 and I'm trying to sell to close. I'm trying to sell this contract that's now worth more than what I paid for to somebody else. So we're going to do what we call a sell to close. So for example, if I have a +1 call that expires on February 28th, which means I own the call and I got debited $50 when I bought this option, and sometimes later it's now trading at $65. So I have a potential to net 15. And to do so, I will do the reverse of the initial trade. I will do a -1 with the same expiration. That's how I get out. Just as a review, coming over here to the left, going over the call that I sold. When I sell options, I want the value of that option to be less and less as time goes on. When I sell a covered call, essentially I want this to go all the way down to 0 at expiration. That way I get to keep my collateral and redeploy the same strategy. Conversely, coming back over here to the right, when I buy an option, I want the value of the premium to increase over time so that I can sell it back at a higher price than I bought it for. Now let's jump over to spreads. There are many different types of spreads, but what we're doing with spreads is we're spreading out a buy option and a sell option. And depending on the premium, we'll either receive a credit for a credit spread or a debit for a debit spread. I'll be going over these multiple leg strategies on a different video, but for now, let's focus on how to close them, which fundamentally is the exact idea as I showed you earlier in this video. So let's take a look at what a spread might look like. For this spread here, let's say I buy a put and the premium is $100. So this is going to be a debit when we buy. Now within the same transaction, maybe I want to sell a covered call against that, and that's worth $150. So I go ahead and execute the strategy, and in doing so, I receive a credit for $50, which is the value of this spread at this moment. Now, maybe sometimes later, the value of that spread has gone down to $25. And now I can close the spread and keep the difference between 50 and 25, which is $25. How do I do that? I have to close them with a -1 and a +1 with the same strike and same expiration. So the same way I entered both trades in one transaction, I would do the reverse in one transaction as well. Jumping over to closing a long call butterfly. If you don't know what that is, I did a video on it and I'll link it right here. But in a long call butterfly, you're gonna have a -2 in the middle here, close to the share price. Then I'll have a +1 above that and a +1 below that. To close this, I'll need to do the exact opposite. So +2 right here. And then we're gonna have a -1 above that and a -1 below that. Basically the exact same trade in the opposite, and we're gonna have to use the exact same expiration date and the exact same strike prices, and I want to do all that in one transaction, same as when I open up the trade. To trade options successfully, you need to identify an underlying asset that you can track on a regular basis and understand its movements in and out. One of the most important parts about trading options is risk management. So it's best to start small and build up your skills to help you generate profits on a consistent basis over time. Please remember to do your own due diligence before any type of investing or trading, as I'm not a financial advisor. The thoughts expressed in this video are just my opinion. If you want to see a step-by-step video on how to invest for the long term for beginners, check out this video right here. If you want to see the video that YouTube thinks you'll enjoy, check out the video there. That's going to be it for this video, guys. If you enjoyed it, smash that like button and be sure to subscribe to see more content. Thank you for stopping by this week. Peace.